Hey everyone, welcome back to another video. This video is going to be specifically focused on how I use TradingView in conjunction with Composer to build simple symphonies and also a little bit more complicated symphonies. So I'm going to run through 3 ways that I use TradingView to build strategies in Composer. So the first way I use TradingView to build a symphony is I look at the 200-day moving average on the S&P 500. In this case, I'm looking at SPY, SPY, that is an S&P 500 ETF, and this black line here is the 200-day moving average for SPY. So you can see when the price action is above this black line, we're in a general uptrend or a bull market. The S&P 500 has a very healthy respect for the 200-day moving average, and that's why I like to use it. You can see it sort of touches, and continues, and then you can see it starts a new trend if it closes below the 200-day. So generally I like to use the 200-day as a long-term trend for the S&P 500. So the way that I can build that in Composer is if I want to ride this trend, I simply will go to my Composer. I've already plugged in the name here, SPY Long-Term Trading, and it's set to a daily trade setting. You can set it to weekly, monthly, whatever you want, but I do enjoy using the daily. So I'm going to go here, select the if-else conditional, and what I'm going to do is set the conditions for the trades. So it's going to be very simple. I'm going to go here to function, select current price, and then where it says choose asset, you're going to put in SPY, pops up there, and then you're going to do greater than, because you want the current price of SPY to be greater than. Go here, select moving average of price, and then number of trading days. You're going to enter 200 for the 200-day moving average. Same thing here, you're going to put SPY. So it's going to look like this. Current price of SPY is greater than the 200-day moving average of price of SPY. So once you've set up the parameters, if this condition is met, then this is the asset that you're going to buy. So here I'm going to enter SPY, and this will tell me that I'm going long in SPY if it's above its 200-day moving average. Now, if it's below its 200-day moving average, let's just take this the 2008 financial crisis, for example. You can see the trend is now rejecting off of the 200-day and continuing lower for a prolonged period. So we don't want to be long in SPY when it's trading below that black line. So what I do is simply go to bonds. So I like to use BSV. This is a Vanguard short-term bond, and I'll enter that there. So if it's below its 200-day, it'll say else here. This just means that it's not above its 200-day and that we're going to go to bonds. And then you can run the back test and see what the results look like. So I'm going to go down here, and I'm actually going to set this as far back as I can possibly go. I believe it's somewhere around 2007. Yeah, 2007. Okay, so I think it's about April. Okay, so here is what your strategy will look like if you're trading solely based off the 200-day moving average. So the reason I do this is to avoid recessionary declines, market crashes, things like that. So if I kind of zoom backwards here and go to the crash of 2008, you can see that we pretty much avoided the most violent drops in the market while the SPY continued to sell off. So we lost a little bit, but we didn't lose nearly as much as buy and hold. And then right around here, SPY closed back above its 200-day move average, and you can see the strategy bought back in and then faltered a little bit here based on the 200-day and then continued again. Same thing right here once again, and then continued about right there. So it's just a good rule that I use to do long-term investing on the SPY. Now you'll notice it's underperforming buy and hold, right? So that's fine. I'm not looking to outperform buy and hold. By doing this, I'm just looking to mitigate the risk. So you can see my max drawdown is 21.1%. The annual return is 7.6. Now, if you compare that to buy and hold, you can see here, this is buy and hold. The max drawdown is 55%, and the annual return is 9%. So that is a simple way to do some long-term investing while mitigating risk and avoiding big downtrends in the market, essentially. Okay, so to add on to that, one other step I like to do is when I'm in the bull market, I do like to transition to long-term bonds if the market starts to get volatile or if it starts to get frothy, overbought on a long-term uptrend, things like that. So what I do is I look at the 60-day RSI on SPY. So this is the RSI chart down here. I've plotted two black horizontal lines on the chart. The first one is at 60, the second one is at 50. And what this does is this shows me a general range that the SPY will trade within. So as you can see here, it's pretty much above the 200-day all through this period here. Now, if you look down at the 60-day RSI, you can see it trades in a range of 50 to 60. You can see sometimes it dips below, sometimes it dips above, but the range is 50 to 60. So what I like to do is when it goes above 60 is when I like to transition to long-term bonds. So that could be TLT, that could be IEF. They'll both work. So this is what that would look like in Composer. So you'll go here, and where you're long in SPY, you're going to simply delete and add another if-else condition. So the new parameters are going to be if the RSI, the relative strength index, so you're going to do that there, and it's going to be a 60-day RSI. By the way, this is trading days for those that may not be familiar. So 60 trading days would amount to about 3 months, three trading months. The weekends don't count. This is simply weekdays. So 60 days would be 3 months in the market. So 60-day RSI of SPY is greater than 60. So right here it shows fixed value. You're going to toggle that on, and then you're going to enter the value as 60. So it'll look like that. 60-day relative strength index of SPY is greater than 60. So if that is met, I'm going to go to, I'll do IEF. You can, like I said, you could do IEF or TLT, it doesn't really matter. They both perform relatively the same. Obviously, they're a little different, but IEF is a 7 to 10 year treasury bond, and TLT is a 20 plus year treasury bond. So I'll start with IEF, since it's a little bit shorter term. So if that condition is met, we're going to sell SPY and move to IEF. If this condition is not met, we're going to stay in SPY. So I'll plug that in there. All right, so now everything's plugged in, and then I'm going to rerun my back test. So these are the results of the original back test with just flat SPY, and now we'll do with the 60-day RSI rule. All right, so let me go down here. So you can see what that does is actually the strategy tends to outperform the SPY over a prolonged period. So if I go to the Great Financial Crisis, here we were in BSV, and then when you're in a bull market trend is where you're going to be transitioning to IEF or the long-term bonds. So what you can do to see that is you'll go to a bull market period. So you can see right here, both are on the same trajectory because they're both just long in SPY because it's above its 200-day. However, the strategy transitions here to IEF because the 60-day RSI is above 60 on the SPY. So you're just sort of taking a risk-off approach and going to bonds because the S&P 500 is starting to become heavily overbought. And so you can kind of ride the trend a little higher before going back to SPY, and then you can see it sort of makes its decline. And you'll see that play out multiple times over your strategy. You can see it play out here. It was not successful there. Let's see where else we can. You can see it play out here. So SPY rode above it, and then you can see here the strategy started to outperform SPY because it was in bonds while SPY was faltering a little bit down here. So it just kind of is a risk-off approach if there's some sort of a mean reversion on the 60-day RSI as the S&P 500 becomes overbought. So see right there, it dipped down. It was in bonds while the market continued higher. So doesn't always work, but it works more than it doesn't, and you can see that in the backtest results. So the annual return is 8.8. The max drawdown is now 20. So before it was 21%. So the max drawdown has come down, and the annual return has actually increased. So again, this is what that would look like. If I hit the back button and basically undo. Oh, come on. Actually, here, we'll just do it this way. Okay, so 8.8, let me copy this. All right, so if you're not doing that, your returns are 7.6 and max drawdown 21. But by transitioning to bonds on the 60-day RSI chart, your returns go to 8.8 and your max drawdown comes down to 20.4. So again, this is what that would look like on the RSI chart. You can see up here. Actually, I'm going to zoom in. So as it goes above 60, you can see the RSI sort of flattens out, and then there's a mean reversion right there where it drops back in the range and then dips down and then sort of trades back in its range again. So that is the 60-day RSI on the S&P 500. Okay, so if you erase IEF and enter TLT and run the test, you should get a little bit better performance. So yeah, if you transition to TLT, which is the 20 plus year treasury bond, you can get 10.1% annual return while keeping the same max drawdown around 20.4%. So that is the other alternative. You can do other things too. You don't have to use those two. That's just what I like to use. So moving on. Okay. So number 2, the second thing I like to do with TradingView and Composer is buy the dips in a bear market. So now I'm going to be looking at the trend below the 200-day moving average. So I have a chart here. This is the SPY, and then this is QQQ, which is a NASDAQ ETF. So what I like to do is buy dips on the NASDAQ when the S&P 500 is below its 200-day moving average. So let me look over here. Okay, so the way that I do that is I look at the 10-day RSI on QQQ. You can use the 14-day RSI. It works as well, but I prefer the 10-day. So when looking at the 10-day, really all I do is drop a line at the 30 mark. 30 is considered oversold. So what I like to do is buy a position on the NASDAQ when it becomes oversold. And what I'm doing is I'm looking for a mean reversion to the upside. So if the stock is oversold, generally it doesn't stay there long and it tends to have a bounce upward. And so all I'm trying to do is catch the bounce upward. So what that looks like in Composer is you would do it here, since the price of SPY is less than the 200-day moving average. It's not going to occur here. It's going to occur down here. So I'm going to delete BSV, and keep in mind the numbers right now. So the annual return is 10.1. The max drawdown is 20.4. So we're going to delete BSV, and then I'm going to add a condition. It's an if-then statement. So here I'm going to choose RSI. Number of trading days is going to be 10. And then instead of SPY, I'm going to go to QQQ. And I'm going to choose less than, because I want to buy it when it's less than 30. So go here, fixed value, enter 30, and it's going to look like that. And then here I'm going to plug in. You can plug in QQQ. I actually like to use XLK, which is a technology sector ETF. So it's a good chunk of the NASDAQ, but it's specifically focused on tech. And the reason I like to do that is because tech, when they do have bounces, the bounces are typically much bigger than, say, the S&P 500, the Dow, QQQ. Tech usually has the biggest mean reversions, so that's why I like to use it. But again, you could use something else if you wanted to. And then if it's not below 30, you're simply just going to stay in bonds. And then I'm going to run the back test. Okay, so now it's showing an annual return of 18.2% and a max drawdown of 17.5. So notice how the going back to 2007, just by simply buying the dips in the bear market, the strategy outperforms buy and hold S&P 500 the whole time. They never even come close to each other again, and that's just by simply buying the dips. So that's actually this is probably my number one favorite thing to do, but you are taking on some risk, just so you're aware, because in a bear market, when you're going all in on a dip like this, the market could continue to fall 3, 4, 5 days, 7, 8 days. You just don't know. So you are taking a risk, but as you can see here, it in the long run, it's rewarding. So the max drawdown decreased, and yet the annual returns increased. So if you go back to the great financial crisis, this is what the dip buying will look like. And that starts right around here. So you could see about right there was probably a dip buy. Over here, let's see, there's probably some dip buying there, dip buying here. Now this is where you're taking the risk, because you could see the market just continuously fell, and we just kept waiting for the bounce. Finally got a bounce right about there, and then where it starts to pay off is when it keeps bouncing in the future like that. So these are just quick mean reversions. They're basically one-day bounces, but you can see how catching these bounces and then transitioning back to your short-term bonds, you quickly start to recover your losses. And the market bottomed right here. The SPY was negative 48, and yet the strategy with the dip buying was plus 45%. So it does help. Again, it's a little riskier, but I'm willing to take the risk to get the reward. So where it really pays off is also when you have something like the COVID crash, which occurred right here at the beginning of 2020. So let me back up a little bit. Okay. So this is what the COVID crash looked like by just simply doing the dip buying. You have an initial decline, and then you can see caught a bounce here, decline more, caught a bounce there, caught a big bounce there, and then it continued to decline. It's actually in bonds right here, but bonds started to decline briefly before returning upwards. So at the bottom of COVID, you can see the SPY was negative 27, and yet the strategy was positive 24%. So it's just things like that. It's not always going to work, but in the long term, if you're looking to stay invested, typically it works. So this is the crash of 2018, sort of a flash crash. You're going to have these strong sell-offs. This was a 2 or a 3 day sell-off, and then you caught the bounce up. So that's what that looks like. Let's go one more spot. So this was 2015, 2016. So this is where you can get caught right here. This happened in August of 2015. So we were going long on the technology sector, but you can see it just continued to fall with the rest of the market, and then we caught the bounce. However, we weren't positive yet. So caught another bounce. Let's see. Got back in the market, declined again. So now we're underperforming the SPY. However, at the bottom, we started catching the mean reversions, and then now we're back above the SPY. So you have to be patient with things like that. If you're dip buying, it's more risk, but it can tend to be a nice reward. So if you look at the year to date for 2022, we've basically been in a decline all year. However, due to the dip buys, we did catch some bounces back upward, and the strategy is basically flat for the year, while the S&P 500 is still negative. So it does help out, but you have to be patient with it. Okay, and the third way I like to use TradingView in conjunction with Composer is shorting the market. Now, I don't recommend shorting to most people. It's again, it's very risky, and it's definitely not for everybody, but it is something that I like to use in Composer in a downtrend. So this chart I'm looking at is the QQQ. This is the NASDAQ 1X normal chart. So this blue line here is the 20-day moving average of the price, and the black is the 200. So what I like to do is take a short position when the price is below the 200-day and below the 20-day. I'm just trying to catch trends downward. Now, it's risky because, number one, you don't know when the trend could reverse and you could get chopped up. The market can go sideways like it did right here, and you will also get chopped up. So you're definitely taking on more risk. There's no question about it. But anyway, what it looks like is it's going to occur down here after the dip buys. So I'm going to delete BSV. As of right now, the annual returns 18.2%. The max drawdown is 17.5%. So what I'll do is simply add another if-then statement. I'm going to choose the current price of QQQ, and I'm going to go less than the moving average of price for a 20 trading day period. Okay, and then so I could simply just put a short position like PSQ, for example. However, I like to have something more than that. I don't just want to have a purely short position because it's going to be extremely volatile and there's going to be a lot of choppiness and the max drawdowns could significantly increase. But I'm gonna put it on here anyway just to show you what it looks like. All right, so the annual return increases to 23.4%, but the max drawdown also increases from 17.5 to about 25.5. So what I like to do is actually delete this and do a filter function here. So the filter, it says sort and filter assets by their attributes and other indicators. So what I want to do is basically sort between bonds or a shorting position. The way I like to filter them is by their RSI, and I like to do the 10-day RSI, but you can also do the 14-day RSI. They both work. So sort by 10-day RSI. So select simply means, well, I'll show you. So the function I'm going to do, you could do select top or bottom. This just means you can select the top performing asset or the bottom performing asset. So basically you could select the one that's doing better or select the one that's doing worse. I'm going to select the one that's doing better. And then how many, I'm just going to enter 1 because I just want to take one position. If you enter 2, 3, 4, it just means that you're going to have 2 or 3, 4 positions at the same time from a list of different assets. So that's going to look like that. And then here in this block is going to be PSQ, which is a 1x inverse ETF of QQQ. So whatever QQQ does, PSQ is going to do the opposite in the 1x direction. There's 2x, there's 3x leveraged. I'm just going to stick with the 1x. And then I'm going to add BSV. You also could do long-term bonds. Obviously, long-term bonds perform better than short-term bonds, typically in a downward trend. But for now, I'm just going to use BSV versus PSQ. So basically, all this is going to do is select whichever one has the stronger 10-day RSI. What that would look like is if I go here to indicators in TradingView, there's a indicator called RSI compare. So you can select this RSI compare, and what you can do is actually compare the RSI of two assets. So if I go to inputs, just enter 10-day period, change this to BSV, which is that Vanguard short-term bond, and then this is going to be PSQ. Select that, and then I'm going to remove that because that line shows whatever asset is selected on your chart. So I'm just removing that so I can compare strictly BSV to PSQ, which is the green and the red line. So you can see here they sort of are correlated, but not exactly. So what this does in a downtrend is sort of gives me a get in and get out feature. So BSV is the green line and PSQ is the red line. So below this 20-day move average, the strategy is going to follow whichever one has the stronger RSI. You can see PSQ is higher pretty much this entire period. However, as the price of QQQ starts to trend higher, PSQ starts to fall, and you can see, let's see, here, BSV actually overtakes QQQ, and so what Composer is going to do is sell your position in PSQ and go back to a bonds position. And that's what that function is right there. Let's see, did I already run it? I don't think I ran it yet. Okay, so the annual return is 24.7 and the max drawdown is 22.7. So before it was 23 and 25, and now it's 24 and 22. So it reduces the max drawdown and gives you a little bit better of return. Again, it's because you're using the filter and you're using bonds as an indicator to basically tell you when to exit the position of PSQ. So you will hold these two not at the same time, but you will transition from one to the other in a downward trend below that 20-day move average. So if we go here, you can see it play out in the 2008 crash, and actually again in 2022. So you can see the strategy start to move upward once the hard recession really starts to take a foothold in October of 2008. So the strategy trends higher. It's doing the dip buys and it's shorting the market when the market is not in an oversold position. So by the time the market bottomed, the strategy was positive. Where is it at? About right here. Strategy was positive over 100%, while the S&P 500 was negative 50. And then it moves to bonds when it's not below that 20-day move average, and then continues higher once SPY closes above its 200-day. So you can see that play out in 2008. It plays out a few other times, but the markets are not they're not down for a very long period of time until we get to, let's see, 2022. So actually, I'm going to go up here, hit year to date. Because we've been in a bear market basically the entire year. So right around January, February, the S&P 500 closed below its 200-day, and then you can see the strategy starts to perform separately from the S&P 500 buy and hold. Here, you can see it starts to short the market, move back over to bonds, short the market again, move to bonds here, and then in, what is this, August. So August, shorting the market once again while the market, the buy and hold falls. And then here, you're getting chopped up because of indecision on QQQ, and then back over to bonds here. So year to date, the strategy is up 48%, while the S&P 500 is still in negative territory. So here, this will make a lot of people nervous. Again, like I said, it's not for everybody. I don't recommend it for most people because you can get chopped up. So here, let's go to the last few weeks or so. So this is QQQ. You can see its 20-day move average is basically flat. It's slowly sloping upward, but it's also approaching its 200-day move average. So there could be a lot of volatility in a scenario like this because the market is still deciding which way to go, especially right now. We're still facing Fed rate hikes. We're still facing high inflation that potentially could be cooling off, but we don't know if it's peaked yet. And so you could, as these two moving averages converge on each other, you could have a lot of volatility. So a strategy like this could experience some harsh drawdowns in this sort of a period where you're almost coming to a crossroads, essentially. So just keep that in mind. But that is how I use Composer with TradingView to build overall trading strategies, whether it's short-term trades or long-term momentum trades. Okay, and then one last thing I'll do is I will just substitute BSV with IEF and TLT just to see what it does to the performance of the strategy. But honestly, you could use all three. So IEF is a 7 to 10 year treasury bond. So you could use that as an indicator to exit PSQ, which gives an annual return of 25.4% and a max drawdown of 19.2%. So this actually performs better than BSV as an indicator under normal market conditions. However, this will struggle as opposed to BSV in conditions like we have today with high inflation, Fed rate hikes, that sort of a thing. So you have to keep that in mind and keep an eye on that. If you're going to be building strategies like this, you need to pay attention to how bonds are performing and make your own call. But typically, long-term bonds will do better than short-term bonds in a downtrending market when conditions as far as inflation goes and the Federal Reserve is not hiking rates and inflation is relatively normal. So we can remove IEF and do TLT and run that as well. It should have about the same results. Yeah, the results are about the same. So this just shows that it's not necessarily overfit is kind of what I'm trying to show. So short-term bonds like BSV or longer-term bonds like IEF and TLT, you could use any of the three and you're still going to have pretty strong performance as opposed to the buy and hold S&P 500. So the final results of these three scenarios here. So first scenario being just long-term trading on the SPY. Second scenario, buying the dips on the NASDAQ. And third, shorting the NASDAQ. So the overall results of that, the cumulative return is 3,559%, which equates to 25.9% annualized, Sharpe ratio 1.32, standard deviation of 18.8%, max drawdown of 20 versus a max drawdown of 55 on buy and hold, which is really, really good. Honestly, this is probably what most people are going to be concerned with. Kalmar ratio 1.25 as opposed to 0.16 on the S&P 500. So that's just three ways that I use Composer in conjunction with TradingView to build strategies. That's about all I have for you guys. So we'll see you on the next video. Thanks for watching.